In exercise 719, we take a look at a relatively simple, straightforward exercise dealing with notes receivable. In this exercise, we're told that on June 30th, 2024, we sold some merchandise to a customer for $30,000. In payment, they agreed to accept a 6% note requiring payment of interest and principal on March 31st, 2025. The 6% rate is appropriate for this situation. So again, dates are very important over here. We have June 30th, 2024 is the date of the note. Payment will be made on March 31st, 2025. So July 1st to December 31st is 6 months. Jan 1st to March 31st is 3 months. So we have a total of 9 months. So let me go ahead and do a calculation over here. My interest rate is 6%. The face value of the note is $30,000. So when I do the calculation, I take the calculation of 30,000 times 6% for 9 months. Because I have a total of 9 months on this note, it is $1,350. So this is for 9 months. Now I'll be doing journal entries on December 31st. Well, I'll do the first journal entry on June 30th, then December 31st, and then March 31st. So let's start with the journal entry on the date we made the note. So we are the ones who made the sale. So it's notes receivable debit. We are the ones who will get the money. We sold merchandise to a customer, so it's sales revenue. We know the amount is $30,000. So they've asked us to prepare the journal entry to record the sale. So we did that. They told us omit cost of goods sold. They've not given us that information, so we can't do that. Next is December 31st. Now, why do we do a journal entry on December 31st? Because we want to accrue 6 months interest. We're not going to get paid today. We'll get paid on March 31st. So of this 9 months, I want only 6 months interest in order to accrue it. I need 6 months, 6 months in December 2024. Okay, so I have $900. 6%, 30,000 times 6/12 will give me 900. Or you could just take this number and multiply it by 6/12 and you'll get this 900. So my journal entry on December 31st is interest receivable debit, interest revenue credit. I'm not getting the money today, but I'm accruing the interest so I can prepare my financial statements. And then finally on March 31st, I will get my money. How much money am I going to get? I'm getting the full 30,000 that's owed to me, plus the full 1,350. Okay, the full 1,350. So let's take a look at what I'm going to do over here. I'll credit notes receivable 30,000 because that's what I had it in my book set, 30,000. Okay. I will credit interest receivable 900. Remember, I had this interest receivable. I take that off my books. That remaining amount, balance of 450, I credit interest revenue. So again, when you're looking at those calculations, this should be this number times 3/9. It'll be 450, and that's what we're recognizing here. So we recognize interest revenue for 6 months on December 31st, and then we recognize the remaining 3 months of interest revenue. Let me put this in a different color. And that is, it's 3 months, not 6 months. I recognize on March 31st. Total interest revenue is $1,350. That customer is not going to pay me interest for more than 9 months. I can recognize a total of $1,350. It's a matter of when I recognize it. So accrual accounting says I should recognize 900 on December 31st and the remaining 450 on March 31st of the next year. So in part 1, we are asked to prepare the journal entries to record the sale. We did that. December 31st interest accrual, we did that. And then March 31st, collecting the interest and the note, the money that was due to us, a total of $31,350. We got all of that money over here. Yeah, 31,350. We got all of that money over there. Now let's take a look at part two. In part two, they tell us if the December 31st adjusting entry for the interest accrual is not prepared, what happens to the income before taxes for the 2 years, 2024 and 2025? So what's the impact of not doing this revenue recognition over here? So in part two, let's play things out over here again. So I have this journal entry identical. We do not do this journal entry. So I'll write the word omitted. So we omitted this journal entry. Obviously, that's a mistake. Now, what's happening on March 31st? My customer is paying me cash. How much cash will they pay me? I forgot to recognize this interest over here. That doesn't matter to them. They don't care how we do our accounting. They're going to give me the 31,500. They give me the full amount, 31,350. Okay, so they're going to give me the full 9 months interest. So what do I do in my books over here? I recognize the entire amount, 1,350 as interest revenue in 2025, and notes receivable, I take it off my books at 30. Okay. So the problem we have now is over here. Let's put this in a different color here. So I had done revenue recognition of 900 here and 450 in 2024 and 2025. Here, because I made this mistake, I recognized all of it in 2025. So the question they're asking us is, what happens to the income in 2024 and 2025? Do we have an understatement or do we have an overstatement? So in the year 2024, what happens? I did not recognize that, right? So my net income is going to be understated by 900. And then what happens in 2025? Instead of having only 450, I have 1350. So now it's going to be overstated by 900. So it's a matter of timing when I recognize it. Well, is this permissible? Obviously not. We'll need to go back and do an error correction so that we can show the income was understated over here and in 2025 it is overstated. The net effect is the same between the 2 years. However, there's a reason for us to do annual financial statements. Otherwise, what's the point of doing that? Okay, so this was a simple exercise. The emphasis was more on the second part. What's the impact of not doing the accrual entry? So with this, let's move on to the next exercise.